China's role as a financier to Africa is undergoing a major shift. New data shows a sharp decline in Beijing's loan financing, even as African nations increasingly send money back to China in debt repayments. Let's decode what this means for the continent's development and global economic ties. New figures show that Chinese lending to African countries fell dramatically in 2024. It dropped to just about $2 billion, nearly half the amount from the previous year, and the lowest level seen since before the pandemic. This marks a stark departure from the peak of nearly $28 billion in loans China committed to the continent in 2016, largely under the umbrella of infrastructure initiatives tied to the Belt and Road. The contraction reflects Beijing's shift away from big-ticket, dollar-denominated infrastructure financing towards more selective and commercially oriented projects, often financed in Chinese yuan or through foreign direct investment. In 2024, only 6 new Chinese-backed projects in Africa received direct financing, with the largest going to Angola for power grids and road improvement. Smaller loans went to Kenya, Egypt, Senegal, and the Democratic Republic of Congo. At the same time, a new report by WION Data reveals that many African nations now send more money to China in debt repayments than they receive in fresh loans. Over the past decade, net financial flows have flipped dramatically. From 2015 all the way to 2019, China ran a $30 billion financing surplus with African countries, which has turned into a $22 billion net outflow from 2020 all the way to 2024 as repayments outpace new lending. The trend underscores a broader rebalancing of Africa's development finance landscape. Multilateral lenders, including institutions such as the World Bank and African Development Bank, have reason to provide the majority of net financing. The institutions now account for about 56% of total development finance flows once debt service is factored in. Economists say the decline in Chinese loans reflects Beijing's more cautious risk appetite after several African countries, including Zambia, Ghana, and Ethiopia, struggled to service debt following economic stress during and after the pandemic. It also aligns with China's broader strategic pivot towards targeted investment, trade credit, and foreign direct investment rather than large-scale loan finance. For African governments, the drop in new Chinese loans presents both challenges and opportunities. On one hand, reduced access to low-cost financing could constrain public infrastructure spending. On the other, reliance on multilateral financing and domestic accountability may grow as external debt pressures shift. Let's now listen to our correspondent, Kalden Ongmu, who reports from Johannesburg.
China's footprint in Africa was long defined by large-scale infrastructure, roads, railways, ports, and other projects that visibly reshaped the continent. By funding highways in Kenya and building rail networks in Ethiopia, Beijing established itself as a central driver of African development. That model is now shifting to strategic investments and a lower risk appetite for financing infrastructure projects. Experts say that Chinese banks lent so much in the past decade, now they are becoming more risk averse. The lenders are feeling increased pressure on their balance sheets and do not want so many non-performing or unpaid loans. While this may slow some traditional infrastructure financing, it could also push African countries towards more diverse, balanced, and potentially sustainable development partnerships. This is Kalden Ongmu from Johannesburg, South Africa for WION World is One.